National Convergence of Capital Measurement and Capital Standards. So we will have a quick look at what are the key elements of that framework and how is it helping the banking industry. So just to start off, this framework is built on three major pillars. One, the minimum capital requirements, which is more to talk about from the perspective of credit risk, market risk, and operations risk. What are the minimum capital requirements for the banks? How much capital do they need to have to protect themselves against the credit risk, the market risk, and the operations risk? So this is from a quantitative kind of a dimension. Calculations of how much capital is required. We'll see the various mechanisms that are involved in it, various formulas that are suggested by BASEL, and various processes that are suggested by BASEL for the computation of the minimum capital requirement. So for credit risk, there are various mechanisms. For market risk, there are various mechanisms, and for operations risk, there are various. And finally, the overall economic capital, which is the capital to protect the bank against the unexpected losses. Even that's the total amount. That is what is required. Then the second pillar on which the BASEL is primarily based on is the qualitative aspects, wherein the supervisory review, right, basically some kind of mechanisms to assess whether the capital the bank is maintaining is adequate to address the various risks it is facing. So primarily looking at the capital adequacy, and if at all there are some kind of violations, we're taking the necessary corrective actions to reduce those violations. Those come under the supervisory review part. So there is a lookout on the capital adequacy assessment. There is a lookout on the strategy adopted by the bank, and even their ability to monitor and ensure the compliance with the regulatory ratios. So there is a tier 1 ratio, tier 2 capital ratio, all these things. From a regulatory dimension, what is the adequacy the bank has with respect to the handling of the risk. Then finally, the third pillar, which is more and more critical here, is the market discipline process. Make sure that the stakeholders, right, stakeholders who have either invested in the bank or lent to the bank or acting in the lender capacity to the bank in any role, in any format, they are well informed about the various risks, so that the entire risk, they can do their own risk assessment and assess the bank for its risk profile as well as capital adequacy. So these are these are the three of the key pillars on the basis of which we see that the BASEL 2 has been built upon. And of course, in each one of these, there is a very detailed aspect with respect to computations, and then the process, and then how it needs to be communicated and shared with the various stakeholders. Right? Now, just moving a little bit into this, to which all kinds of companies or institutions can we apply this BASEL to? Straightforward, all internationally active banks. That is where the convergence to the international standards is coming up. All internationally active banks, the holding companies, suppose Bank 1 and Bank 2 are under the are under the common parent called XYZ holding. Then along with applying BASEL to this, even at the holding level also the BASEL is more and more applicable, or whichever. Probably this holding company may not be a bank, but if it has a banking company as one of its subsidiaries, then obviously it should be, the BASEL should be implemented even at the holding company level also. And any bank having multiple subsidiaries in multiple geographies, each subsidiary also need to be evaluated based on the BASEL. And any other banks which are having, or any other firms which are holding related businesses, or a bank having an insurance company also, some kind of a related business, even then these two need to be consolidated and presented, especially if there are a bank is having a subsidiary of some other bank or some other related business like insurance companies or something, then at an aggregate level, at a consolidated level, the BASEL needs to be implemented. Now here we talk about here let's look at the definition of capital so that then we can see with respect to credit risk, with respect to market risk, and with respect to operations risk, how can a bank get into the calculation of capital. So for that, as a simple Basel II norm, the total capital should be at least 8% of total risk weighted assets. So I can find out, so for me the task now is find the total risk weighted assets. Now the word or this definition of risk weighted assets is defined differently for capital, for credit risk, for market risk, and for operations risk. And whatever is the way I am finding out the total risk weighted assets, the 8% of that will be the minimum capital requirement. And in that capital also there has been a breakdown, there has been a breakup. There is something called tier 1 capital, tier 2 capital, and tier 3. So out of the total 8% of risk weighted assets, this is the minimum total. But in this it could be composed of tier 1, tier 2, and tier 3 capital. So tier 1 is the core. Tier 1 is the core where we talk about the shareholders' equity. It could be in the form of common stock or in the form of preferred stock. But that preferred stock should be non-redeemable. It should not be, it should be for an indefinite period. It should be non-redeemable and non-cumulative. In case the dividends are not paid on this in a particular year, they are not carried forward for the next year. So non-redeemable, non-cumulative kind of a preference stock and common stock, which generally have the last or the least claim against the assets of the firm in case of liquidation. So they all go as a part of the shareholders' equity. And then we also talk about the disclosed earnings, disclosed retained earnings. See, from a bank's standpoint, whichever are the retained earnings that are present as a part of their balance sheet, under that retained earnings section, we treat them as the disclosed earnings and the disclosed retained earnings. So the disclosed retained earnings which are shown in the balance sheet, they also go as a part of your tier 1 capital. So these two put together, generally as per Basel II, these two put together form around 4% of the total capital. right? The minimum thing is the 4% of the total risk weighted assets, means 50% of the total capital requirement. So this forms almost 4% of the total risk weighted assets. And when it comes to tier 2 capital, which is generally called as a supplemental capital, wherein the capital is generally in the form of debt or some preferred stock, but not those which are having the least claim on the assets. So some undisclosed reserves, revaluation reserves which may exist sometimes, which may not exist, which may exist for a temporary period, or any hybrid debt capital investment which behave both as debt as well as equity, like convertible bonds, convertible preferred stocks. They can behave as a debt as well as an equity. And subordinated term debt. So the subordinated is having a very last claim on the among all the various debt investors. So the subordinated debt receives the claims of the assets after all the senior claims have received. So that is why, so these are very close to equity, but they are not equities. Same thing, I mean, undisclosed reserves, revaluation reserves, and the hybrid debt capital, they are close to equity, but they are not but they are not equity as these things, right? So they have a limited life because there may be a period, right? Probably preferred stock could have been issued for a 5 years or a 10-year period. That subordinated debts will have a maturity period of, let's say, 10 years. And they also have a charge against the future income. This is one more thing. They have a charge against the future income, means some specific definite payment is what they are expecting.